There is a silence in the financial markets right now that is louder than any scream. It is an eerie, unnatural calm that usually precedes a catastrophic geological event, while the retail investor is glued to their screen, cheering for the latest all-time high in the S&P 500, cheering for the AI revolution, and cheering for the promise of Federal Reserve rate cuts. The tectonic plates of the global financial system have quietly shifted beneath our feet. Most people didn't feel it, but one man did, and his reaction should terrify you. Warren Buffett, the Oracle of Omaha, the man who has seen every boom, every bust, every bubble, and every crash since the Second World War, has just posted a number on his balance sheet that defies all logic, all precedent, and all optimism. $382 billion. Let me repeat that slowly so it sinks in. $382,000. That is not a typo. That is the amount of liquid cash and short-term treasury bills currently sitting in Berkshire Hathaway's war chest. To give you a sense of the sheer monstrous scale of this number, Warren Buffett now holds more cash than the entire gross domestic product of countries like Finland, Chile, or Portugal. He holds more cash than the entire market capitalization of Bank of America. He holds more cash than Walt Disney. He holds more cash than Coca-Cola. Think about the implications of that. The greatest capital allocator in the history of modern capitalism, a man whose entire career is built on the philosophy of compounding and time in the market, has effectively liquidated his portfolio. He has looked at the landscape of American businesses, from technology to banking to retail, and he has said, "I do not want to own this." He is not buying the dip. He is not dollar-cost averaging. He is engaging in the most aggressive, systematic liquidation event we have ever seen. He has sold half of his Apple stake, the company he once called the crown jewel of his empire. He has dumped billions of dollars in Bank of America stock, selling day after day, week after week, regardless of the price. He is exiting the casino of Wall Street with a speed that suggests he knows the doors are about to be locked. The mainstream media, Bloomberg, CNBC, the Wall Street Journal, are trying to sanitize this. They are telling you that Buffett is just old, that he is conservative, or that he is simply rebalancing. Do not believe them. That is a comforting lie designed to keep you holding the bag. Buffett is not rebalancing. He is fleeing. He is looking at the Buffett indicator, the ratio of the total stock market value to the GDP of the United States, and he sees it flashing red. He sees a market that is valued at levels that mathematically guarantee a lost decade of returns. He sees a consumer that is drowning in credit card debt. He sees a government that is adding $1 trillion of debt every 100 days just to keep the lights on. He is signaling, with $382 billion of conviction, that the soft landing narrative is a trap. He is betting that the liquidity in the system is about to evaporate overnight. He is building a bunker because he doesn't just see a recession coming. He sees a regime change. And if you are sitting there with your 401k fully invested in passive index funds, thinking that stocks always go up in the long run, you are missing the signal. You are standing on the train tracks, watching the light of the oncoming train and convincing yourself it is the sunrise. To truly understand why this specific cash pile is the ultimate sell signal, we have to strip away the complex financial jargon and look at the mechanics of the market itself. We need to deconstruct the myth of liquidity. Your financial advisor has told you a lie. They have told you that the stock market is a place where you can always get your money out. They have told you that because you can sell your shares on an app in a millisecond today, you will be able to do the same thing in a crash. But Warren Buffett understands the dark truth of market structure. Liquidity is a coward. It is there when you don't need it, and it vanishes the moment you do. Let me use a brutal analogy to explain what is happening right now. Imagine the US stock market is a massive, exclusive nightclub. It is the hottest club in the world. Inside, the party is raging. The music is deafening. The champagne is flowing. You have the retail investors dancing on the tables. You have the hedge funds in the VIP section. You have the pension funds at the bar. Everyone feels rich. Everyone is looking at their phone, seeing their crypto up, their Nvidia stock up, their home value up. They feel invincible. The DJ is the Federal Reserve, and for the last 15 years, the DJ has been pumping a drug into the ventilation system called quantitative easing. It keeps the energy high. It keeps the people dancing even when they are exhausted. But Warren Buffett is the old man sitting in the dark corner by the exit. He has his coat on. He isn't drinking. He isn't dancing. He is watching the room with cold, calculating eyes. He notices something that the drunk dancers are missing. He has counted the people in the room. There are 10,000 people packed inside. And then, he looks at the exit. There is only one door, and that door is narrow. In normal times, people leave one by one to go home and the system works. But Buffett is running a simulation in his head. He asks the question nobody else is daring to ask. What happens if someone shouts fire? What happens if a war breaks out in the Middle East that doubles the price of oil overnight? What happens if the US Treasury auction fails and interest rates spike to 8%? What happens if a major bank declares insolvency? When the fire alarm rings, the psychology of the crowd shifts instantly from greed to survival. 10,000 people try to run through a door built for one person. It is a stampede. People get crushed, and in that moment of panic, what is the value of your ticket to the party? What is the value of your S&P 500 ETF? It is zero. Not because the companies are worthless, but because you cannot get out. The market makers, the high-frequency trading algorithms that provide the liquidity, are programmed to turn off when volatility spikes. They pull their bids. The buy button disappears from the screen. The price you see on your phone right now is a nominal illusion. It is the price of the last trade executed in a calm market. It is not the price you will get in a panic. By selling billions of dollars of stock now, while the music is still blasting and everyone is euphoric, Buffett is walking out the door calmly. He is cashing out his chips while the cashier still has money in the drawer. He is accepting that he might look stupid for a few months if the market goes higher. He doesn't care. He knows that the smart money sells to the dumb money on the way up. And right now, the dumb money is leveraging their house to buy call options, while the smart money is buying 3-month treasury bills. He knows that when the inevitable correction triggers, the door will be locked from the outside. The $382 billion isn't just cash, it is his freedom. He is out of the building. You are still inside. We need to take this out of the theoretical realm and put it directly into your living room. I want you to feel the texture of this crisis. I want you to experience the liquidity trap before it actually happens to you. I want you to close your eyes. Seriously, close them. Imagine it is a Tuesday morning in mid-2026. The date doesn't matter, but the feeling does. The last few weeks have been strange. The news has been filled with reports of a credit event in Japan, or maybe a failed bond auction in Europe. But you didn't pay much attention. You've seen volatility before. You held on through 2020. You held on through 2022. You have diamond hands. But this morning is different. You wake up at 6:30 a.m. You reach for your phone on the nightstand. The screen light hurts your eyes. You see the notifications. Not one or two, but dozens. They are stacked on top of each other. Market futures halted limit down. Trading suspended on NYSE due to volatility imbalance. Liquidity freeze. You feel a cold, physical spike of adrenaline hit your stomach. It's that primal fight-or-flight response. You sit up. You tap your brokerage app icon. Robinhood, Fidelity, Schwab, E-Trade. It doesn't matter which one, they all use the same plumbing. The app doesn't open. It hangs on the loading screen. The logo just pulses. Pulse, pulse, pulse. Network error. Please try again later. You try again, and again. Finally, after 10 agonizing minutes, you get in. The numbers are red, deep, violent, blood red. Your portfolio is down 22% since yesterday's close. Your tech stocks are down 35%. Your crypto is down 50%. You do the math in your head instantly. You just lost your house down payment. You just lost 2 years of salary. Panic takes over. You don't care about long-term investing anymore. You just want to save what is left. You want to stop the bleeding. You hit the sell all button on your main index fund. Usually, this takes a microsecond. You hear the little ding and you see your cash balance go up. You feel relief. But today there is no ding. The spinning wheel on your screen just keeps spinning. Order pending. You wait. You stare at the screen. 1 minute. 2 minutes. The price on the ticker drops another 2%. Order pending. You go to Twitter at X to see what's happening. X's market crash is trending. People are screaming that they can't sell. People are posting screenshots of their frozen accounts. 5 minutes pass. Finally, a notification pops up on your screen. Order partially filled. You check the trade details. You sold. But not at the price you saw when you clicked the button. You sold 12% lower than that. Why? Because the market moved faster than your app. Because there were no buyers. The exit door was clogged. You were sold out at the bottom of a liquidity air pocket. You sigh. At least you are out. At least you have cash. You try to transfer the cash to your bank account. You need to see the money in your checking account to feel safe. You need to know you can buy food. You tap withdraw. A new pop-up appears, one you have never seen before. Withdrawal delayed. Due to extreme market conditions and high volume, standard settlement times are extended to T+5 days. 5 days. Your money is in limbo. You are technically liquid, but practically broke. You walk into the kitchen. Your spouse is making coffee. They look at you and ask, "Is everything okay?" You look pale. What do you say? How do you explain that the safety net you spent 10 years building just dissolved in 10 minutes? How do you explain that you saw the warnings, you saw Buffett selling, you saw the videos, but you didn't act? This feeling, this helpless, suffocating realization that you are trapped, is the nightmare Warren Buffett has avoided. He is sitting outside the club, holding $382 billion in treasury bills, watching the building burn. He is calm. He is ready. And he is about to buy your portfolio from you for pennies on the dollar. The experts on TV will tell you, this time is different. They will tell you that AI has changed the productivity paradigm, that technology stocks justify their infinite valuations, and that the Federal Reserve has learned from its mistakes. They always say, this time is different, right before the crash. It is the most dangerous phrase in the English language. But Warren Buffett operates on a different timeline. He doesn't have the memory of a goldfish. He has the memory of a historian. He remembers 1969. The parallels between 1969 and today are so precise, it is frightening. In 1969, the market was in a speculative mania called the go-go years. It was the era of the nifty 50, 50 stocks that were considered one-decision stocks. You bought them and you never sold them. Companies like Polaroid, Xerox, IBM, Kodak, they were the magnificent seven of their day. They were the technology leaders. They were trading at 50, 60, 80 times earnings. The narrative was that they could never fail. Buffett looked at the market in 1969 and said, I can't find anything to buy. He didn't just hold cash. He did something that shocked Wall Street. He wrote a letter to his investors and dissolved his partnership. He gave them their money back. He effectively said, I am quitting. The game is rigged. The madness is too high. I will not play. People mocked him. The media called him outdated. They said he didn't understand the new era. Does that sound familiar? It is exactly what they are saying about him selling Apple today. Then came 1973 and 1974. The market crashed 50%. The nifty 50, those invincible tech stocks, lost 80% to 90% of their value. Polaroid went from $149 to $14. Inflation skyrocketed. It was a bloodbath. The people who mocked Buffett were wiped out. They lost their fortunes. They lost their homes. Buffett returned a few years later, calm and collected, and bought the exact same companies for pennies on the dollar. He bought the Washington Post. He bought Geico. He built the foundation of the empire we see today because he stepped aside when the train was coming. He did it again in 1999. During the dot-com bubble, he was mocked for refusing to buy internet stocks. Buffett doesn't get the internet, they said. He hoarded cash. When the Nasdaq fell 78%, he was the last man standing. Today, the $382 billion pile is the loudest echo of 1969 and 1999 we have ever seen. He is screaming at us that the risk-to-reward ratio is broken. He is telling us that the return on capital is irrelevant right now. The only thing that matters is the return of capital. He knows that history doesn't repeat itself perfectly, but it rhymes. And right now, the rhyme is a funeral march. But here is the plot twist. Here is the hidden mechanism that makes the 2026 crisis different from 1969 or 1999. This is the detail that the casual observers miss, and it is the key to understanding Buffett's strategy. Most people think Buffett is holding cash because he loves the US dollar. They think he is betting on the dollar. The truth is the exact opposite. He is betting against the stability of the currency itself. Look closely at what he is holding. He is not holding cash in a checking account at Wells Fargo. He is holding short-term treasury bills, T-bills. These are government bonds that mature in 3 months or 6 months. Why is this distinction critical? Because Buffett knows that we are facing a sovereign debt crisis. The US government has $36 trillion in debt and is adding $1 trillion every 100 days. The interest on the debt is now higher than the defense budget. In this environment, we enter a phase called fiscal dominance. This means the Federal Reserve loses control. The government must print money to pay its bills. When they print money, inflation spikes. If inflation spikes, long-term bonds, 10-year or 30-year treasuries, get crushed. Their value drops significantly because their fixed interest rates become worthless in real terms. But short-term bills are different. They are cash equivalents. They roll over quickly. If inflation goes to 10%, his T-bills will reset and pay him 10%. He is protected. The twist is that Buffett isn't holding cash to keep it forever. He is holding cash as a weapon. He knows that when the credit cycle breaks, when the banks stop lending and the maturity wall of corporate debt hits in 2026, cash becomes the most valuable asset in the world. Not because it buys groceries, but because it buys hard assets from distressed sellers. He is preparing for a fire sale of real things. He wants to buy energy pipelines. He wants to buy railroad tracks. He wants to buy productive farmland. He wants to buy factories. He knows that the dollar is dying a slow death, but in the specific moment of a crash, the dollar spikes in value temporarily because everyone needs it to pay debts. He plans to use that temporary spike, that moment of maximum liquidity desperation, to trade his paper dollars for real assets that will survive the currency collapse. He is not exiting the market to retire. He is exiting the market to own the market when it resets. So how is the Oracle positioned right now? We need to look under the hood of Berkshire Hathaway to see the specific bets he is making. It is a masterclass in defensive positioning. What he is selling: the toxic assets. First, the banks. He has slashed his positions in Bank of America, US Bancorp, and others. Why? Because he knows the banking system is technically insolvent. The banks are sitting on trillions of dollars of unrealized losses in commercial real estate, empty office buildings, and long-term bonds, which crashed when rates went up. In a higher-for-longer rate environment, the banks are zombies. If there is a run on the banks like we saw in 2023, the equity holders get wiped out. Buffett is getting out before the next bank run. He knows the government will bail out the depositors, but they will not bail out the shareholders. Second, consumer tech. Apple. He sold half his stake. This was his favorite company. Why sell now? Because Apple is a proxy for the American consumer. It sells $200 phones and monthly subscriptions. Buffett knows the consumer is broke. The credit cards are maxed out. The personal savings rate is near zero. When the recession hits, the first thing people stop buying is the new iPhone. The first thing they cancel is the subscription. He is monetizing the consumer bubble before it pops. He is selling the want to buy the need. What he is buying, holding, the survival assets. First, energy, Occidental Petroleum, Chevron. He continues to buy oil stocks aggressively. Why? Because oil is physics. The economy cannot run without it. Even if the stock market closes, even if the dollar crashes, oil has intrinsic value. It powers the military, the supply chain, and the grid. It is his hedge against the destruction of the fiat currency. You cannot print oil. Second, short-term T-bills. This is his dry powder. It pays him 4.5% or 5% to wait, risk-free. Think about the risk profile. Why would he risk his money in the S&P 500, which is trading at 25x earnings, an earnings yield of 4%, when he can get 5% risk-free from the government? The market is not paying him to take risk, so he is taking no risk. He has effectively constructed a barbell portfolio: extreme safety on one side, cash, and real hard assets on the other, energy. He has completely skipped the middle, the speculative tech stocks, the banks, the retailers, where most retail investors are trapped. The warning is clear. The siren is blaring. The smartest money in the world is shouting at you to get out of the way. But knowing is only half the battle. Action is what saves you. The title says, get out, but where do you go? Here is your survival guide for the liquidity crunch of 2026. Action 1. Build your own cash fortress. Stop reinvesting dividends into an overvalued market blindly. Stop dollar-cost averaging into the S&P 500 if you need that money in the next 5 years. Start accumulating a cash position. Aim for 20% to 30% of your portfolio in high-yield liquid assets. Specific tool. Look at ETFs like SGOV or BIL, Treasury Bill ETFs, or a high-yield money market fund at your broker. These give you the safety of cash with the yield of treasuries. Do not leave cash sitting in a checking account earning 0%. That is losing money. Make your cash work, but keep it liquid. Action 2. Audit your liquidity. Do you own assets that are hard to sell? Do you have money in private equity funds, non-traded REITs, or collectible cars, watches? In a crash, these markets go no bid. You cannot sell them. The gates close. If you anticipate needing money in the next 12 to 24 months, sell these illiquid assets now while there is still a buyer. Do not wait for the panic. Liquidity is a premium today. It will be a scarcity tomorrow. Action 3. The stop-loss discipline. If you insist on staying in the stock market because of FOMO, you must have protection. Set trailing. Stop losses on your high-flying tech stocks. If the market turns, the algorithm sells for you before your emotions take over. If Nvidia or Tesla drops 15%, get out. Don't become a bag holder hoping for a rebound. Don't be a hero. Be a survivor. Action 4. Pivot to hard assets. Follow Buffett into energy. Consider allocating a portion of your portfolio, 10–15%, to energy ETFs, like XLE or VDE, or physical commodities. When the paper bubble bursts, capital flows to resources. When the screen goes red, energy stays green. The final verdict on the $382 billion signal is undeniable. Warren Buffett is not guessing. He is preparing. He has seen this movie before, in 1969, in 1999, in 2008. He knows exactly how it ends. It ends with the retail investor, you, holding overvalued stocks while the smart money holds the cash to buy them from you at the bottom. It ends with a transfer of wealth from the impatient to the patient, from the optimistic to the realistic. The system is correcting. The debt wall is hitting. The liquidity is draining. Buffett has exited the building. The door is closing. You still have time to walk out, but you have to move now. Do not let the media lull you into a false sense of security with their record-high headlines. The silence of the crash is what makes it deadly. No one is coming to save you, not the Fed, not the government. You have to save yourself. I am immensely grateful to you for staying until the end of this critical warning. This information is your shield in the coming storm. If you found this breakdown valuable, make sure to like and subscribe so we can keep bringing you the truth about the financial system that the brochures leave out. Stay vigilant, stay liquid, and we will see you in the next video.